Good afternoon, everyone. I'm Ben Gonzalez with TDI's Communications Office, and thank you for joining us today for our webinar about new insurance legislation from the 88th regular session. We're going to give you an overview of which bills became law this year, and then we'll outline TDI's rulemaking related to those new laws. We've got a short presentation first that's going to cover the legislative overview, and then we'll come back here for a live Q&A session. If you are planning to earn TDI continuing education credits today, you do have to stay for the whole hour, both the presentation and that Q&A session. All right, we'll get started with the presentation and we'll see you back here shortly.
Hi, my name's Kenesha Schuster. I'm the Associate Commissioner of Government Relations here at the Department of Insurance. Thank you so much for joining me for this overview of the 88th legislative session. First, a little bit about TDI. TDI regulates more than 3,300 companies and licenses more than 827,000 insurance agents and adjusters. TDI also regulates life insurance and the fully insured insurance plans, property and casualty insurance products. We register insurance coverage of amusement rides, and TDI also houses the State Fire Marshal's Office and the Division of Workers' Compensation. Today, we're going to talk about the 88th legislative session. Each regular session begins in January of odd-numbered years and lasts for 140 days, from about January through May. Once a bill passes out of both houses, it goes to the governor. And once session ends, the governor has an additional 20 days to sign a bill, veto a bill, or let it become law without a signature. The governor can also call a 30-day special session. We're currently in the fourth special session of the 88th legislature, but they've dealt mostly with property tax relief and school choice, not insurance issues. First, we're going to talk about TDI biennial recommendations. TDI must submit a report with legislative recommendations before each regular legislative session. Our recommendations were broadly aimed at expanding consumer protections, eliminating out-of-date regulations, and improving agency efficiency. TDI submitted 9 recommendations, and 8 of them ultimately passed into law. So let's take a look at those. First up is House Bill 1900, which requires more notice for non-renewal or cancellation. Coverage and policy conditions vary greatly among insurers, and consumers may need more time to evaluate their options when insurers won't renew their insurance policies. House Bill 1900 gives policyholders 60 days notice. Similarly, governmental entities will have the same 60-day notice as other commercial risks. Consumers can visit TDI's Help Insure website to shop for coverage. TDI expects to adopt rules to implement this legislation. Next is House Bill 1901, dealing with electronic title audit reports. Title insurance protects ownership of property, and in Texas, title policy language is the same, no matter which title company is issuing the policy. All Texas companies also charge the same rates for title insurance, though there may be differences in closing costs and fees. TDI regulates title insurance companies and agents, and previously the law required paper filings of their annual audit reports. So those subject to reporting had to submit that audit report using certified mail. Then TDI had to manage and scan paper filings for retention and processing. So allowing electronic submission will reduce costs for agents and improve TDI efficiency. TDI issued a bulletin on this, but we don't anticipate adopting rules. House Bill 1903, relaxing capital stock requirements, was a recommendation aimed at reducing regulatory burdens. The insurance code required stock insurers to have at least 50% of their authorized stock issued and outstanding, otherwise sold to a shareholder. This requirement has been in place since at least 1961 for some types of stock. The requirement also limited the number of shares that could be authorized when the insurer was formed and resulted in TDI receiving a filing when those insurers wanted to expand to other states. So removing this requirement doesn't harm consumers and reduces regulatory burdens on insurers. And we don't anticipate rules. Up next is another recommendation aimed at efficiency and moving away from paper processes. The Occupations Code allowed a licensed fireworks manufacturer or distributor to purchase retail firework permit booklets from SFMO in books containing 20 permits each. Those booklets, which contained carbon copies of each permit, were returned to SFMO at the end of each calendar year. Then SFMO was required to manually enter information from those carbon copy booklets and issue refunds for any unsold permits. SFMO already had an electronic process in place, but were still processing requests for paper booklets. Processing paper booklets also led to higher costs, possible delays, and increased risk of data entry errors. This recommendation streamlines the process by removing the paper booklet option. We expect to adopt rules in spring of 2024. Next is House Bill 2839, dealing with liquidity stress testing for large life insurers. Large life insurers can be sensitive to liquidity issues that also affect the broader financial markets. So after the 2008 financial crisis, there were several attempts to assess the potential market impacts of liquidity stress in the life insurance industry. But a lot of the analysis was based on assumptions and observations. So to provide a more evidence-based analysis for insurers potentially vulnerable to liquidity stress, the NAIC developed a liquidity stress test framework for large life insurers who write a significant amount of the products that could generate a large demand for payout and reduced liquidity. The aim for this monitoring framework is to help predict and protect from financial markets assuming a large amount of asset sales and becoming challenged to the point of financial peril. Insurers subject to these requirements only have to report to their lead state. We expect rules in winter of 2023 soon. Next is House Bill 3673, streamlining reserves requirements for life insurers. Companies must keep reserves in order to pay claims. In 2015, the Texas legislature adopted the NAIC model law, creating principles-based reserving requirements, also known as PBR. Prior to that legislation, there was a one-size-fits-all formula in statute for life insurance companies to set their reserves. The NAIC came up with a model for principles-based reserves to right-size reserves based on how much risk a company was taking on. Reserves that were too high could raise the cost of insurance, while reserves that are set too low can increase the risk of an insurer not being able to pay claims and becoming insolvent. The statute directs TDI to adopt a rule that substantially matches the valuation manual created by NAIC that includes the guidelines for principles-based reserving. In 2015, because those requirements were new and potentially burdensome for small companies had language from the original manual included in the statute to ensure that the small company exemption stayed in place. The NAIC recently updated the manual to exempt more types of policies that have been found not to need the more rigorous PBR requirements. So House Bill 3673 removed the language in statute that applied the exemption only to the small companies that were contemplated in the original manual. By removing that language, Texas statute will align and exempt more companies from these principles-based requirements. The next TDI biennial recommendation is Senate Bill 1003. In 2019, the legislature expanded provider directory requirements to allow consumers to search for doctors who practice at in-network facilities. Directories must list specified types of facility-based physicians like radiologists, anesthesiologists, pathologists, emergency department physicians, neonatologists, and assistant surgeons. But consumers looking for other types of facility-based providers were not able to look up those providers in the directory. Senate Bill 1003 amends the language to include more types of facility-based providers in order to help consumers plan their care, avoid accidentally using out-of-network providers, and maximize their in-network benefits. We expect rules in mid-2024 for Senate Bill 1003. The last TDI biennial we'll touch base on is Senate Bill 1286, which aims to create clarity on certain waivers during a catastrophe. Prompt payment laws provide claim submission and payment deadline exceptions if a provider or insurer misses a deadline as a result of a catastrophic event that substantially interferes with normal business operations. The rule implementing this law requires a health plan or provider to notify the agency within 5 days of the catastrophic event and within 10 days of resuming normal business operations. If the entity meets the notification requirements, TDI will suspend claim submission and payment deadlines. However, in March 2020, Governor Abbott suspended certain claim handling deadlines, and TDI issued a bulletin which together extended claim handling deadlines for an additional 15 days across the state to help issuers respond to COVID-19. Governor Abbott rescinded the statute suspension in September of 2021, and the temporary claim handling deadline was canceled. But some health plans asserted their need to bypass the deadlines beyond the expiration of the statutory suspension. They said that the statute did not authorize TDI to limit the duration of relief from those deadlines. So Senate Bill 1286 amends the statute to resolve uncertainty and authorizes TDI to approve, disapprove, or limit requests for relief from claim handling deadlines. So companies can't avoid paying prompt payment penalties. Next, we'll talk about Senate Bill 1659, which delays TDI's sunset review. In government, sunset reviews regularly assess the need for a state agency or program to exist. In Texas, the sunset process works by setting an expiration date in law for state agencies. An agency will automatically be abolished on its sunset date unless the legislature passes a bill to continue it, typically for another 12 years. A rigorous evaluation process before the sunset date provides the legislature an opportunity to closely examine an agency's mission, priorities, and performance, and take action to address any problems identified. The Sunset Advisory Commission is a 12-member body. It's got 5 senators and 1 public member appointed by the lieutenant governor. It has 5 members of the House of Representatives and a public member appointed by the Speaker of the House. The Sunset Commission employs an executive director who oversees about 30 staff that conducts these independent sunset reviews. So during the 88th legislature, sunset staff asked that TDI sunset review be delayed in Senate Bill 1659. So instead of being reviewed in the 2024-2025 cycle, TDI will be at closer to 18 years since its last review, when it next goes through the sunset review cycle in 2028-2029. Next, we'll cover a set of legislation that affects the Texas Windstorm Insurance Association, also known as TWIA. The Texas legislature created TWIA in 1971 to provide windstorm and hail coverage to those who are unable to obtain insurance from the voluntary insurance market. TWIA provides windstorm and hail insurance in areas exposed to hurricanes, and currently it provides coverage in the 14 first-tier coastal counties on the map and a portion of Harris County east of State Highway 146. Its structure and operations are largely codified in Texas statute. TWIA issues insurance policies like an insurance company. However, it also functions as a pooling mechanism. So all property insurers licensed in Texas are required to become TWIA members as a condition of doing business in the state. Our first TWIA bill is House Bill 3208, which limits premium refunds from TWIA. TWIA also issues biennial recommendations to the legislature, so a lot of these bills were based on TWIA recommendation. In the voluntary market, most companies refund the portion of premium that is unearned based on how long the policy was in force. But since TWIA is an insurer of last resort, House Bill 3208 limits refunds to a purchase of similar coverage in the voluntary market, a sale or total loss of the property, or if TWIA determines that the property is no longer insurable. And the insured has to provide proof if one of those situations apply. We anticipate rules in 2024 for this legislation. House Bill 3310 is another TWIA recommendation dealing with appraisal deadlines. Appraisal is the statutorily prescribed way that TWIA and policyholders resolve disputes about the amount of loss that TWIA pays for the accepted portion of a claim. Appraisal does not deal with disputes about whether or not a loss is covered. In the association's experience after Hurricane Harvey, they saw that several factors led to unnecessary delays, and so they recommended that TDI adopt deadlines for the appraisal process. This will apply to appraisal demands that arise on or after January 1 of 2024. House Bill 3311 is a TWIA recommendation to simplify the appointment of insurance industry board members. All TWIA board members are appointed by the TDI commissioner, but statute previously included a requirement for TWIA to send a slate of candidates for the industry spot. TWIA had a difficult time getting a full slate together, and TDI was not required to use the slate, so removal of that requirement should simplify board appointments. Senate Bill 2232 is a TWIA recommendation to allow TWIA to implement some agent requirements. TWIA doesn't appoint agents, and they don't contract with agents. So an agent who offers or sells TWIA policies is not an agent of TWIA. Their plan of operations requires TWIA to audit agent compliance with specific eligibility requirements, but it did not expressly give them authority to take any action on noncompliance. So Senate Bill 2232 allows TWIA to establish requirements, audit for compliance, and then limit an agent from offering a policy if they are non-compliant. Senate Bill 2233 deals with automatic renewal of TWIA policies. TWIA implemented automatic renewal of policies following a sunset review in the 86th legislative session, but due to complexities of the commercial market and the more dynamic nature of property and coverage needs, they found that commercial policyholders might be better served by a traditional non-automatic renewal process, so they can involve the agent for assistance. TWIA has an agent advisory group that also supported this recommendation. Moving on to some general insurance legislation, House Bill 1040 expands the ability of insurers to conduct business electronically as the default. Previously, regulated entities had more limits on conducting business electronically. For example, they had to obtain the written consent of other parties before conducting business electronically, which could be difficult or cumbersome. House Bill 1040 allows companies to conduct business electronically, provided all parties agree or receive notice and don't request otherwise. The bill also requires delivering written communication for cancellation or termination in paper or other non-electronic form. Companies supporting the legislation say this will save them time and money, leading to increased efficiency and better customer service. We hope to adopt rules in spring of 2024 for this legislation. Next up is House Bill 1074, dealing with anti-rebating provisions in the statute. Various sections in Insurance Code Chapter 1806 generally prohibit rebating, inducements to buy policies, and unfair discrimination among insureds. House Bill 1074 allows insurers and agents to give free or discounted services and other offerings related to loss control that will not be considered a rebate. The services or offerings must be at a reasonable cost to the insurer or agent and may not be made in an unfairly discriminatory manner. The products may be offered in personal and commercial lines. So some examples could include water detection and shutoff valves, leak detection products, wildfire prevention services, or cybersecurity services. There's also some consumer protections built in. Except for loss control purposes, insurers and agents cannot share consumer data and information obtained from any of those products or services. Senate Bill 224 is meant to curb the increasing rates of catalytic converter theft. With respect to insurance, the bill increases the amount of funds collected by insurers that must be paid to the Motor Vehicle Crime Prevention Authority. Currently, each insurer must pay $4 per motor vehicle year of insurance, and Senate Bill 224 increases that to $5. The additional dollar will be deposited in the General Revenue Fund to be used only for certain regulatory and law enforcement activities to detect and prevent catalytic converter theft. The bill creates offenses for damage to, theft of, or possession of a stolen catalytic converter, and also establishes policies related to businesses that deal with catalytic converters. House Bill 1706 establishes the right of an insured to hire a licensed public insurance adjuster. Certain insurance carriers, particularly surplus lines, which are not subject to the same regulatory oversight as other insurers in Texas, have sought to restrict or remove the ability of an insured to hire a public adjuster. So House Bill 1706 prohibits an insurance policy from restricting that right. It includes residential and commercial property insurance issued by Capital Stock, Mutual, County Mutual, or Farm Mutual Insurance Company, a Lloyd's plan, a reciprocal or inter-insurance exchange, and because of how surplus lines policies are regulated, it applies to surplus lines insurers where Texas is the home state. House Bill 2065 is a technical adjustment to legislation from the 87th legislative session. When a claim is filed with an insurance company of an at-fault driver, the at-fault driver must cooperate in the claims process or face non-renewal by the insurance company. The update acknowledges that sometimes the driver that needs to cooperate may not be the person named on the policy, but is a person who's insured because they had permission to drive the car. It also clarifies that it is meant to apply to third-party claims, which is where a claim is filed against another person's insurance policy. Senate Bill 2008 expands the ability of farm mutual companies to operate in areas with larger populations. Farm mutual insurance companies were established to provide a limited set of coverages to rural and underserved areas of the state. So the population limit was limited from 2,500 to 6,500 to acknowledge the growth in Texas and allow farm mutuals to continue providing coverage and competition for those rural areas that they were designed to serve. This was a multi-session effort. Bills to expand their reach have been filed for a few sessions, but it made it across the finish line this session. Next is House Bill 2188, dealing with TDI statistical agent requirements. TDI uses a statistical agent for reports that gather claims information, and an organization has to have relevant experience to qualify as a statistical agent, and the statute required 5 years of relevant experience. There were new market entrants who thought the 5-year requirement was an unjustified barrier to their ability to compete to do this work with TDI. So House Bill 2188 reduces that to 2 years of experience. Next is House Bill 3359, dealing with network adequacy and access plans. House Bill 3359 expands requirements around health plan network adequacy. Health plans employ networks of providers to contain costs. In a network, each provider contracts with the plan to care for its members for an agreed payment. If a doctor or facility has no contract with that plan, they're considered out of network and may charge consumers full price under some circumstances. Texas has had appointment and wait time distance standards for health plan networks for some time. And to determine if a network fulfills the geographic distribution standard, TDI required insurers to submit in-network provider listings and plotted service area maps for each physician and provider type. When a plan does not meet standards, the insurer may file an access plan explaining how network gaps will be covered and how members have access to care, and to ensure that out-of-network providers get fair compensation. Many rural counties have few or no available specialists, so providers send patients to urban areas for specialized care. Due to the vast rural demographics of Texas, access plans relating to a shortage of particular provider types are common. Access plans based on inability to negotiate are more common in urban areas. Some stakeholders particularly wanted to tighten the access plan process, so House Bill 3359 aligns Texas network adequacy requirements with federal standards, including a travel time standard that was not a part of Texas rules already. It also requires a hearing before TDI can grant a waiver or access plan, and adds guardrails for how plans must deal with gaps over time. House Bill 3359 also limits contract changes that may be seen as adverse to providers, such as reducing compensation or moving them to a lower tier in a tiered network plan. The bill also expands reporting requirements to give stakeholders an in-depth look at network adequacy implementation. Additionally, the bill aligns balanced billing protections with federal rules that include not only emergency care, but post-stabilization care and balanced billing protections and dispute resolution in the Texas Independent Dispute Resolution process. TDI hopes to have rules for House Bill 3359 in early 2024. Next is House Bill 711, which is an effort to rein in contract provisions that the legislature deemed as anti-competitive. Each of these contract provisions that are prohibited by House Bill 711 were restrictions on certain actions or communication that might drive consumers to use a provider other than the one in the contract. Now that these provisions will be prohibited, a health plan is subject to a fiduciary duty to ensure that if any steering or tiering occurs, the practices would be in the primary interest of the patient. House Bill 1592 is an expansion of the Texas Balanced Billing Dispute Resolution process. The original statute was effective in January of 2020, but only applies to TDI-regulated plans along with the state teacher and state employee plans, as well as Farm Bureau plans. The Texas law bans balance billing for certain medical services or supplies received on or after January 1 of 2020. Health plans and out-of-network providers must use the Texas Independent Dispute Resolution portal to mediate or arbitrate their disputes. Mediation is used for balance billing disputes between facilities and health plans, and arbitration is used for billing disputes between plans and out-of-network providers. The federal government adopted a similar framework for self-funded plans, which are governed by federal law. But the federal law has been plagued by lawsuits, so lawmakers wanted to provide those plans with an option to use the Texas dispute resolution system. House Bill 1592 will allow self-funded plans to choose to opt in to the Texas process for resolving payment disputes for certain out-of-network care. We have proposed rules implementing House Bill 1592. Staying with balance billing, Senate Bill 2476 expands balance billing protections to ground ambulance transport. Existing balance billing protections use an independent dispute resolution system to reach a reimbursement amount for providers who are not contracted with the plan. Senate Bill 2476 takes a different approach and sets a payment standard. Health plans will be directed to reimburse out-of-network ground EMS agencies at the rates set by their local government entities. TDI has set up a database for providers to enter those locally set rates. If there's no locally set rate, health plans will reimburse at the lesser of the billed charge or 325% of Medicare. This statute includes an expiration date because the federal government is supposed to work on rules to apply federal balance billing protections to ground ambulance, but they haven't thus far. TDI has implemented the database and rules have been proposed. Our next bill is House Bill 290, which expands the types of multiple employer welfare associations that can be formed. Multiple employer welfare associations, or MIWAs, are a way for small businesses to collectively negotiate with health plans. So House Bill 290 broadens the ability to form MIWAs. House Bill 290 allows a MIWA based on geographical association. It also allows working owners to join a MIWA. It waives a requirement that a MIWA has been in existence for at least 2 years. And it authorizes a MEWA to provide comprehensive health plan benefits like a PPO or EPO. And if they choose that structure, then the same rules will apply to a MEWA that will apply to a PPO or EPO structure. These new MEWAs will also have to demonstrate federal compliance with TDI. TDI issued an informal proposal and request for stakeholder input on these rules, and we hope to propose rules by the end of the year. Next up is Senate Bill 510, License Holder Confidentiality. Currently, most information about occupational license holders that's maintained by state licensing agencies can be publicly disclosed to any person who submits a public information request. This legislation designates certain license holder personal identifying information as confidential and not subject to disclosure. And finally, House Bill 1587, which reduces TDI oversight of annuities or certain other products that hold reserves for guaranteed benefits in a separate account rather than the insurer's general account. It also exempts certain life and annuity products from the form filing and approval process. House Bill 1587 limits the need for those products to obtain commissioner approval to use separate accounts for certain company obligations. Thank you so much for joining me for this overview of the 88th legislative session. Our contact information is on the screen if you would like to reach out with any questions or concerns.
All right, welcome back to the Q&A portion of our webinar. Let's have our panelists turn on their cameras. All right, thank you so much. Joining us now to answer your questions is our presenter, Kenesha Schuster. Kenesha is the Associate Commissioner of Government Relations for TDI, leading the GR team in bill tracking and serving as resources for Texas lawmakers and stakeholders on insurance issues. Also joining Kenesha today to help field questions is Robert Simons from TDI's General Counsel Division. Robert's the Assistant Director of the Office for Policy Development Counsel. And joining us also from General Counsel is TDI Attorney Elizabeth Rett. Well, we see several of you are asking about the materials. Don't worry about that. We'll be posting on the TDI website, and all participants today will get an email with those links next week. And regarding the CE credit, you should have entered your license information when you registered, and then we'll file that CE for you with TDI, and that takes up to a month to display on CERCOM. Okay, so before we get going, we've just got a couple of ground rules that we always need to pass along. Any questions about a specific company or entity we're not able to answer in this open forum, you can email us those questions to governmentrelations@tdi.texas.gov, and you'll see that email address in the chat as well. I'll also repeat it when we wrap up today. So please use the Q&A feature. I see several of you are already doing that in Zoom to enter your questions. And any that we don't get to during the event, you can always reach out to us again by email, and we'll try to get you that answer. All right, Kenesha, Bob, Elizabeth, ready to take some questions? All right, make sure you unmute your microphones. Here we go. First up, do you have any rules that are currently in the comment period that we can weigh in on? That's a good question.
Yeah, so this is a very, very active period for rulemaking as we kind of roll into implementation. A lot of those bills that Kenesha mentioned, the iron is in the fire, and actually some of these I see in the Q&A. We are currently in the comment period, so it's a very exciting time, a good time to get your opportunity to comment. So the big PPO rules, the network adequacy rules, that's the HB 3359. We expect to publish that in the Texas Register tomorrow. It is actually already on our website. The hearing for that and the comment due date is going to be January 10th. So expect that to be a lively hearing, and please get your comments in. The military licensing related bill, that's SB 422. Those of you who may be insurance agents who are either in the military or a spouse of someone in the military, that provides a lot of strength and protections for you individuals. That was already proposed this month, and the comment period closes January 3rd. The NEIC liquidity stress test framework, that's HB 2839, that also publishes tomorrow, and we are in the comment period for that. So that comment period actually closes January 8th. So notice a slight difference between that one and the network adequacy. That's because we wanted to close the comment period on the hearing that we know we're going to have for that network adequacy rule. I will put a link to the rules, the TDI rule website here for everybody here in the chat in a second. And Elizabeth can mention, I think there's a TWIA rule going on right now, right, Elizabeth?
Yes, the TWIA appraisal rule implementing HB 3310, setting the deadline by which TWIA appraisals must be completed. That was published November 10th, and comments are due December 11th. So that comment deadline's coming up.
So no shortage of things to weigh in on if you want to be part of this process. Kenesha, I think you touched on this during the presentation, but I'll ask you again because it's a good question. Any insurance bills that have been introduced with all the recent special sessions?
No, the special sessions so far, the fourth special session just ended, and they did not deal with any insurance legislation during those specials. We'll see if there's another special.
Could be. Let's see. What's up? What is considered a large life insurance company when talking about the liquidity stress testing requirements?
Very, very large. So actually the rules implementing that bill, that's one of the ones that I mentioned, I actually go publish tomorrow, but you can go get it on the website. And I guess it's like Law and Order ripped from the headlines. The NEIC on December 1st adopted the 2023 liquidity stress test framework. Inside the stress test framework, there is the scope criteria. And so that is how large insurance companies have to be. And it's something like 25 billion of assets for annuities. Last I checked, there were no current Texas domiciled insurers yet, possibly one in the near future who would be subject to that. So those of you who that applies to probably know who you are at this particular time.
Okay, sounds good. Kenesha, any adoption orders that we see coming up soon, and where would we find those?
You can find adoption orders on the same page that Jennifer just put in the chat to everyone on our rules page. There are a few, I think there's a handful of adoption orders that, hopefully are imminent.
Okay, sounds good. And you can also subscribe to TDI emails through Gov Delivery. We have that on our website. Just go to the very bottom and it shows you all our social media links as well as that subscription email. Next up, House Bill 2065. Is there a timeline for an unresponsive party to respond before a decision is made by the carrier?
Yeah, so that's another one where it is actually in the comment period. So someone had requested, multiple folks had requested a hearing. The hearing is going to be next week, actually. We'll get a link here to the TDI calendar. So the comment period was extended. I think that's to December 14th. We'll have a hearing here at the Barbara Jordan Building in Austin on that. So I will say that the proposal does kind of talk about some deadlines. I know that we have already received comments related to some of that, and we are eager to hear more people's opinions on that. So this is a fruitful time to offer us your peace of mind as to how to interpret that insurance code 551 on cooperatives. But there's a lot of interesting stuff going on, and this is precisely the time to give us your input.
Sounds good. All right, next question, health related. Does House Bill 711 apply to the federal self-funded ERISA plans?
It does not. As a general rule, most of the state legislative changes on health plans generally do not apply to self-funded ERISA plans. Those are federally regulated.
Gotcha. Sounds good. So Department of Labor for those. When will Texas House Bill 1592 final rules be released? We thought we were expecting those on December 1st.
They are released. Those are on the same rules webpage. So those rules also include the rules for Senate Bill 2476 on ground ambulance.
and those are published. I believe the comment period has closed. So that is one of the rules where an adoption order should be imminent.
Yeah, to echo Kanisha, I think the cake is nearly done, and I would expect to see that filed with the Texas Register very, very soon. Very soon. So
this is
a little
probably
late on that, but very soon.
This question is probably part of that process as well. Will the ground ambulance mediators and arbitrators be through the regular IDR process?
No. So Senate Bill 2476, like I mentioned, existing balance billing rules use an IDR process to reach a payment standard. But Senate Bill 2476 actually sets a payment standard in the statute. So they won't go through the independent dispute resolution process.
Okay, sounds good. Next up, what is the status for rules surrounding House Bill 1592, please?
That is the same. Senate House Bill 1592 and Senate Bill 2476 are in the same rule. So adoption is imminent.
Right. 2 laws in 1 rule. All right. Next up, any information on the proposed amendments that DWC is considering on TAC Chapter 166. The comment period is still open, but the writer is curious about when this may move into the rulemaking stage.
So I guess that's probably more properly my colleagues who work directly in DWC. We're in the same building, so I'm not sure the status of 166, but I would say just as an outsider, if you want to comment, now's the time.
Yeah, and always email us and we'll get those to the right division. Any updates for Senate Bill 1264?
I would say the only update for Senate Bill 1264 would be House Bill 1592 that adds the ERISA opt-in. So we've got that in the rule.
Okay, sounds good. This one is about the clarifications on the at-fault driver. When will the hearing be, and how soon will the rules be coming out for the at-fault driver claim cooperation? Thoughts there?
Is there
Yeah. The hearing is oh, you know what? I'll put it in the chat here. The hearing is the 14th at 2:30 to 4. I think the comment period was open. So if you cannot make it to Austin and you want to submit comments, so I'm going to post to everyone the link to the docket for the actual hearing. There is a link for the proposal there. It says the Texas Department of Insurance proposes, and that says how to submit a comment. So you can submit a comment to that email address. So it would be chiefclerk@tdi.texas.gov. And I would do that. It's a little bit like a real strict professor. Please don't wait to 5:05 p.m. to submit your comments. So if you're going to get them, we do receive, it's like 90% of comments come the last 3 hours, but please don't be the person who submits comments after that comment deadline has closed.
All right. So if you're thinking about it now, go ahead and send those to us. And that's the way to do it. If you can't be here for the hearing, that's a good way to do it. All right. Let's see. What do we have next? Regarding the 60-day notice required for personal lines, I guess this is when it's not going to be renewed. Is it for new business and renewal policies, that effective date of January 1st?
I'm not sure the answer for that off the top of my head. I'd have to go look at the bill and see what that says exactly. Okay.
So they can go ahead and email us that question again to the government relations email box, and we'll try to get you an answer on that. Any other adoption orders that we need to be on the lookout for coming up soon?
Gosh, so many. So
Right.
Actually from the 87th legislature, SB 1367, there will be a forthcoming adoption order we expect related to exempting commercial lines from certain filing requirements. For those of you who operate in the life and annuity world, you may have noticed this past year, we stripped a bunch of our life and annuity rules into Chapter 3. Chapter 3 was just getting crowded. We moved many of them to Chapter 4. So there is extremely lengthy, very boring proposal and adoption that should be coming out soon. And what that particular proposal, it's supposed to be entirely non-substantive, but it fixes all the cross-references, right? So things point to the right place internally. That should free up some real estate, and those make it easier for those of you who kind of are looking at requirements related to life annuity to find them, so it's not kind of mixed up with the other accident and health related stuff. So I think that's going to make people's lives easier. Maybe not the most exciting rule of all time. The prompt pay waivers adoption order, the comment period is closed on that. We did get quite a few comments on that. So staff is working on that particular proposal and working to get that adopted. We've talked about already about the HB 1592 and the SB 2476, the ERISA opt-in and the ambulance transport. That's the one that we said is very imminent. We've got that upcoming hearing and extended comment deadline for uncooperative auto. Of course, the military licenses, we're hoping to move that adoption order pretty quickly. We've also got the valuation manual updates should continue apace and move pretty forward. And I believe that the TWIA appraisal rule that Elizabeth introduced as a proposal, I think we're hoping to move that one pretty quickly as well. And gosh, I might have missed some, but that's kind of like we're 2/3 halfway through the initial wave, initial tranche of implementation related to the 88th. I see the next question here, I think maybe is about someone's asking, is TDI working on rules for the Vision Managed Care Plan HB 1696? Correct. So that, yeah, you may have noticed that it was not in the initial wave proposals. I think at this time we are still planning on opening up the rules to implement some of those things. So there's that bill, there's a coordination of benefits bill. I don't anticipate those proposals to be particularly exciting. I think for the most part, those are amendments intended to make the rules congruent with the now amended statute. I don't think there's a whole lot of too much excitement to expect in those proposals. That said, I love it when folks give a close read to our proposals and provide comments. So be looking forward to that. I don't think you're going to see that proposal here December, January, but hopefully it is kind of in the next wave of things to be processed here and move out.
Bob, all of these are exciting. Don't kid yourself on that.
They're all beautiful in their own way.
Elegant. Next up, House Bill 1900 related to the notice of cancellation or non-renewal. The changes in this law made by the act apply only to an insurance policy that is delivered or issued for delivery. Let's see what else here. I'm not finding the question in this.
I think they're answering the previous question.
She's provided the answer.
Of course.
Ms. Fankel, if you have a law degree and are interested in employment at the Texas Department of Insurance, please come to our website. We have several openings available.
Emily is a lovely legislative staffer. We thank you, Emily.
Thank you. Is there any support for the Fed IDR process outside of the website?
I'm honestly not sure. We only operate the Texas program, and we have a ton of claims go through that process. So we stick to the Texas IDR and try to support that system.
Very good. Any news on the proposal hearings for the Consumer Bill of Rights and Filings Made Easy updates?
Yeah, those are both in the works and should be coming out relatively soon. I know that there's still kind of finishing touches on the Consumer Bill of Rights, so the amendments to the homeowners and auto Consumer Bill of Rights, and the filing made easy. The withdrawal date here is breathing down our necks. I think it's early to mid-January, and trust me, the folks in my office are very keenly aware that is it's do or die in terms of finishing out that adoption order. So I think we're going to make it. I think we'll get signatures on that, but I guess I can't guarantee anything, but that should be coming here relatively soon. It has to. It's either that or we start over, basically. So
this is that flurry of things getting done right now. House Bill 998, have final rule timings been released on that one?
No, hand that one off to Elizabeth, maybe. I don't believe we've got rules on House Bill 998. That's expanding FAIR Plan.
I don't believe we have any rules in the works on 998.
I think it's early stages, but I
Okay.
do think that was going to be something that we are going to wrap up here before is it the 89th? Do I got the numbers right? I don't
Yeah,
know.
before the 89th.
Pre-filing only 11 months away. So yeah, we definitely want to knock these things out, but I don't have a proposal to give you and share with you right at this moment.
All right, sounds good. I think we're going to wrap it up there because we are quickly approaching our out time. If we did not get your question today, or you think of something else that you're going to need addressed, go ahead and send them to us at governmentrelations@tdi.texas.gov, and we'll get it to the right person and try to get you an answer. Thanks for joining us today. Have a great rest of your day, and we're going to see you at the next TDI webinar.